Came across an old article by Malcolm Gladwell. One day in 1996, a Wall Street trader named Nassim Nicholas Taleb went to see Victor Niederhoffer. You must read it in full, it's fantastic. Look at this snippet about George Soros. Seemed to be successful for a reason too. He used to say that he followed something called the theory of reflexivity. But then, later, Soros wrote that in most situations his theory is so feeble that it can be safely ignored. An old trading partner of Taleb's, a man named Jean-Manuel Rozin, once spent an entire afternoon arguing about the stock market with Soros. Soros was vehemently bearish, and he had an elaborate theory to explain why, which turned out to be entirely wrong. The stock market boomed. 2 years later, Rozin ran into Soros at a tennis tournament. "Do you remember our conversation?" Rozin asked. "I recall it very well," Soros replied. "I changed my mind and made an absolute fortune." He changed his mind. The truest thing about Soros seemed to be what his son Robert once said. "My father will sit down and give you theories to explain why he does this or that. But I remember seeing it as a kid and thinking, Jesus Christ, at least half of this is bullshit. I mean, you know the reason he changes his position on the market or whatever is because his back starts killing him. It has nothing to do with reason. He literally goes into a spasm. And this is his early warning sign. Everything that can be tested must be tested, and so when Taleb started his own hedge fund a few years later, he called it Empirica. Nassim Taleb and his team at Empirica are quants, but they reject the quant orthodoxy because they don't believe that things like the stock market behave in the way that physical phenomena like mortality statistics do. Physical events, whether death rates or poker games, are the predictable function of a limited and stable set of factors and tend to follow what statisticians call a normal distribution, a bell curve. But do the ups and downs of the market follow a bell curve? The economist Eugene Fama once studied stock prices and pointed out that if they followed a normal distribution, you'd expect a really big jump. What he specified as a movement 5 standard deviations from the mean once every 7,000 years. In fact, jumps of that magnitude happen in the stock market every 3 or 4 years because investors don't behave with any kind of statistical orderliness. They change their mind, they do stupid things, they copy each other, they panic. Fama concluded that if you charted the ups and downs of the stock market, the graph would have a fat tail, meaning that at the upper and lower ends of the distribution, there would be many more outlying events than statisticians used to modeling the physical world would have imagined. In the summer of '97, Taleb predicted that the hedge funds, like long-term capital management, were headed for trouble because they did not understand the notion of fat tails. Just a year later, LTCM sold an extraordinary number of options because its computer models told it that the markets ought to be calming down. And what happened? The Russian government defaulted on its bonds, the markets went crazy, and in a matter of weeks, LTCM was finished. Spitznagel, Taleb's head trader, says that he recently heard one of the former top executives of LTCM give a lecture in which he defended the gamble that the fund had made. What he said was, "Look, when I drive home every night in the fall, I see all these leaves scattered around the base of the trees." In other words, the Russians, by defaulting on their bonds, did something they were not supposed to do, once in a lifetime rule-breaking event. But this to Taleb is just the point. In the markets, unlike in the physical universe, the rules of the game can be changed. Central banks can decide to default on government-backed securities. And then describing this, Empirica has done nothing but lose money since last April. We cannot blow up. We can only bleed to death, Taleb says. And bleeding to death, absorbing the pain of steady losses, is precisely what human beings are hardwired to avoid. So you've got a guy who's long on Russian bonds, Savory says he's making money every day. One day lightning strikes and he loses 5 times what he made. Still, on 364 out of 365 days, he was very happily making money. It's much harder to be the other guy, the guy losing money 364 days out of 365, because you start questioning yourself. Am I ever going to make it back? Am I really right? What if it takes 10 years? Will I even be sane 10 years from now? What the normal trader gets from his daily winnings is feedback, the pleasing illusion of progress. Am I ever going to make it back? At Empirica, there's no feedback. It's like you're playing the piano for 10 years and you still can't play chopsticks. And the only thing you have to keep you going is the belief that one day you will wake up and play like Rachmaninoff. Very tough to do that.